Hi, this is Stephen here from Share Navigator, and you're looking at a chart of Cisco at the moment. So we're going to put on an option trade that's going to basically cost you $50 to put on, and you could make a potential $50. And all we need Cisco to do between now and November is actually rise above $26. So this particular option strategy is a trade that allows you to participate with a much lower risk than actually going out and buying the stock. So as you can see, here's our 1 year chart of Cisco. It's traded, as low as $22.50, but right up as high as $30. And we have a 3-month target price of about $26 in this stock, possibly closer to 27. So rather than us actually buying the shares or buying call options and doing other types of strategies, we want a defined risk trade. And a great way of doing that is the bull call spread. So down here you'll see volatility is still high, so this trade will actually work well enough even though volatility is high, because we're going to collect a lot of time premium for selling our $26 call. So there's two parts to this trade. We're going to buy the $25 call options which expire in November, and then we're going to sell the $26 call options which expire in November as well. One part of the trade is bullish, we want the shares to rise, and the other part of the trade basically caps our profit potential at 26. So we're hoping the total cost of this trade will be about $50 per contract, or 50 cents per share, which means that we can make a max profit of 50 cents. So we're going to go ahead now and place that particular trade, and then I'll get into a presentation which will allow you to see it in greater detail. So we've clicked into our spread builder trade, and we're going to start building this trade we talked about. So we'll type Cisco, it's the Cisco stock we want to trade. And you're going to see a number of expiries pop up here. So we're really only focusing in November. We want to give this trade a chance to work out. And the reason we've picked November is it also allows an earnings report to get put in there as well, which always helps if the earnings are good. So you can see here the quotes here. We're going to buy the $25 call. The bid-ask spread here is 151.147, and then selling the $26 call. The bid-ask spread here is $1.94. So we're going to click on the first part, which is to buy the $25 call, and then we're going to click on the bid of the $26 call. So it's basically a call spread that we've created here. We're buying one leg and we're selling the other, and we're limiting our upside potential here. So the cost here, if we were to do it by what they say, is 151, and then we'd be collecting in 94 cents here, which the total cost there is about 57 cents. But we're going to haggle with the market here. We're going to only ask to pay 50 cents. So we'll type in 0.5 here. And we're happy to do 5 contracts in this trade. So the total cost of this trade to us is going to be $250. And our potential profit will be $250 as well if we get filled in the trade. So we're going to click on Submit Order. Are we happy to submit this order? Yes, we are. We click on Override and Transmit. And that's it, the order's gone into the market there now. So if we get filled later on, we'll post out this trade to you. We may up our cost of this trade maybe to 55 cents at a max, but we'll see can we get filled later on at 50. Okay, we're going to do a presentation now explaining this trade in greater detail via PowerPoint. So let's go through this Cisco trade in greater detail. So the bull call spread, it's a bullish trade. It's mildly bullish, and it's considered only mildly bullish because if you were more bullish, you may buy the stock or just buy the long call option. So there's less risk attached to this particular trade than actually buying the stock. It's a debit spread. You're going to pay to place this particular trade. So let's get stuck into it. It's a real life example. We've got filled on Cisco. The stock was trading at $25.53, and we placed the $25/$26 November 20th bull call spread. So what we did was, the first part of the trade, we bought the $25 call and we paid $1.59 per share. So with this part of the trade, we want the share price of Cisco to rise. And then we've capped our profit potential by selling the $26 call. And in that case, we received $1.05 per share. So what we're saying in the second part of the trade is we're giving control of our shares back to somebody else at $26. The first part of the trade was we said we are going to buy control of our shares at $25. So we've limited our profit potential to if Cisco's share price rises to 26 and above. So the net cost of that trade to us was 159 minus what we took in, which was 105, and that's 54 cents per share, or $54 per contract. So for those of you who are new to options, the reason it's $54 per contract is that one contract in the options market controls 100 shares of stock. So what is our risk in this trade? Well, the great news about this, it's limited to the amount that we paid for the debit spread. And in this case, we know it was 54 cents per share or $54 per contract. We can't lose any more than that. That's the great news. So what's our max profit potential? Well, it's the difference between the strike prices. So in Cisco's case, the strike prices we picked was 26 and 25. And the difference between those is $1. Minus what we paid for the trade, which is 46 cents. So the max we can make in this trade is 46 cents per share or $46 per contract. And that will happen if the share price of Cisco trades above $26. From the return on investment perspective, this is why this is such a much better strategy. The first thing is you're not risking a large amount of capital. If you think about Cisco, if you were to buy the shares, you'd pay $25.53, but we've placed in a similar type trade and it's only costing us 54 cents. So we've less risk on the table, plus our return on investment is so much higher. We're making a return on investment, if we're correct on this trade, of 85%, which is significant, I think you'll all agree. What is the break even in this trade? Well, we need Cisco to trade above 25.54. So how you calculate the break even on a bull call spread is you take the long call strike price plus the debit you paid. So in this situation with Cisco, the long call strike was $25. The premium we paid was 54 cents, so our break even is 25.54. Once Cisco trades above that, we're going to be making a profit at our expiry date. What's our probabilities of success in this trade? It's actually 50-50. So our probabilities of winning with this trade is exactly the same as if we bought the stock. But the great thing about this trade is we're not risking the same amount as we are in a stock. So we're getting a massive return on investment for a pretty much similar probability of winning. So just a couple of notes about the bull call spread. How do you go about picking the strikes? Well, that really depends how bullish you are. If you're very, very bullish on a stock, you will pick both strikes which are out of the money. So that means you would pick strike prices which are above the current share price. So in the Cisco example, we probably would have picked, if we were more bullish, maybe the 27.28. If we're moderately bullish, which is what we are in this Cisco trade, we pick strike prices where the share price is in between the long call and the short call. So Cisco at the moment is at 25.53. We bought the $25 call, sold the $26 call. That's moderately bullish. And then least bullish of all is when both calls are in the money. You can also, please note here as well, the wider the strikes you make, the more profit you can make, but also the more risk you take. So we could have done, for example, the $25-27 bull call spread. The benefits of that is you're going to make a lot more money, but the risk is you have to pay a little bit more upfront to put that trade on. So how do you go about managing the trade? Well, most people leave these trades expire at options expiry day. And when you get there, if both calls or the share price is over $26 in this case, you will literally just sell your long call and buy back your short call. It's as simple as that. If it's a situation where the share price is below the short call, you do nothing with the short call, and if there's value left in the long call, you would sell that then. So that's how you would manage the trade. Okay, if you need more information on this trade, please go to our website and to the members forum. Thanks and bye for now.